Hi, this is City, your Canadian CPA. Today's topic is going to make you hungry and guilty at the same time. Picture this. You're at your favorite Chinese restaurant in downtown Toronto. You've just demolished a tower of dim sum, and the bill arrives. At the cashier, they whisper, "Pay cash for 10% off?" Suddenly, you're not just a customer, you're an amateur tax planner who also thinks beef and broccoli is not authentic. You've probably seen this at old-fashioned Chinese restaurants. Sometimes the cashier even claims the debit machine's out of order, despite that accepting debit card and cash sign right next to the counter. So what do restaurant owners really get from this tactic? Is that 10% discount truly a steal for you? Let's go through the background, trace the cash transaction chain, and see if you've scored the good deal. Let's roam. First off, who started this cash discount for Chinese restaurants trend? I hunted for the original mastermind, but there's no plaque saying Mr. Chen invented the 10% cash discount to save on tax. So let's be real. For Chinese or Indian, cash is king. That's also why robbers targeting these ethnicities easier than hitting the bank. So what juicy benefits come with cash? As an accountant with professional skepticism and a caffeine addict dreaming of owning a coffee shop for those cash tip, we look for cracks and benefits from the system. Here's my take on the perks of these cash discounts. First, saving on merchant service fee. You tap your credit card or debit card. Your money is gone, merchant processors snag 2 to 5% before the money even lands in the restaurant's account 2 days later. While we rack up the reward and enjoy our benefit from the credit cards mentioned from last episode, the owner loses a slice of profit. Second, and the illegal one, tax evasion. Canada's self-assessment system trusts you to report everything, but completeness? Auditor's nightmare. After all, we cannot spot what's not on the books. Cash sales? This is a gaping crack for off-the-book magic. Poof. HST and income tax vanish into the black hole. Last, combine them.
I have a pen. I have an apple. Apple pen.
Not Apple Pen, but you get it. Lightning fast cash turnover and a transaction chain under the shadow. Everyone knows the fees, so let's cut deep into points 2 and 3. Are you getting the best deal from those cash discounts? When talking about tax evasion, these unreported cash sales give a green lane for both sales tax and income tax. In Ontario, that means skipping 13% HST and roughly 12.2% corporate income tax. In BC, it takes away government's cut from 5% GST and about 11% corporate income tax. In BC, that 10% cash discount sounds like a good deal. The restaurant shares 10% out of the roughly 16% they're looting from the government. You are getting more than half of the heist. In Ontario, cash payers get a smaller share, 10% out of about a 25.2% raid. Not as tasty as in BC, but still around a 40% share of easy money instead of robbing a bank.
Disclaimer: the income tax part is simplified for easier understanding. Income tax is based on profit, not revenue. We're assuming all costs related to the unreported sales are properly claimed. Please don't sue us if you think you do this evasion tactic.
Hope we won't get into any trouble or any car crash in Scarborough. In Ontario, CRA is effectively losing around 25% on every unreported cash sale. To give you a sense of scale, Back in 2008, Quebec identified approximately $425 million in lost tax money just from POS fraud. Restaurants manipulated their POS system to hide cash sales and block CRA from seeing the real numbers. One high-profile case in Vancouver involved 5 people and 4 sushi restaurants accused of using electronic sales suppression tools to systematically erase cash transactions. When you bring that forward into today's world, the story can be even spicier than wasabi or that pile of radish with green food coloring. Let's move it to the modern day. Instead of old-school sales suppression software, AI is now a possible partner in crime, helping delete or skip recording cash sales to get the same result. On the other hand, some owners just take the simple route. Don't leave any electronic trail at all. Think about the last time you visited a pho place. They hand you a paper order sheet and offer 10% off if you pay cash. Once that paper goes into the garbage, the only evidence left is the cash in the drawer. Now, the spiciest part, like Szechuan cuisine. Tax evasion is not like forgetting a tax slip on your personal tax return. CRA sends you a letter, helps you adjust your return, and you pay some interest and small penalty. That is like the mild salsa. When you intentionally evade tax, the penalty isn't 5% anymore. It can go up to 200% of the tax evaded, plus a potential vacation sponsored by the Crown, with free meals inside a jail. Based on a CRA newsletter, from 2019 to 2020, there were 32 convictions related to tax evasion, with 13 taxpayers sent to jail for a total of about 18.5 years. The total tax evaded was around $7.4 million. One of the most talked about cases was announced guilty on January 5, 2021 in Halifax, Nova Scotia. A business person with potential Greek background was fined about $113,000, roughly 100% of the HST evaded during a 6-month period in 2012. But in a rare twist, a CRA restaurant case ended with a payout to the taxpayers. In 2018, a Nanaimo, BC restaurant owner couple was awarded nearly $1.7 million after a judge found CRA pursued them with a malicious prosecution. CRA believed the couple's large cash deposits were hidden restaurant income. The couple said it was decades of personal savings. The court slammed CRA's investigation as incomplete and ordered compensation. Classic confirmation bias, looking only for evidence that screams tax evasion and ignoring the rest of the story. There's no perfect statistical proof showing how big the cash problem is in Canada, but media reports and enforcement actions demonstrate governments losing millions annually. While most people paying their fair share, some owners pay less and share a small slice of that tax saving with you as a food discount. With that much money disappearing annually, CRA is very motivated to crack down on the underground economy. Before we get into that chain, let's talk about how CRA actually audits and finds that one piece of chow mein sticking out of the plate.
Disclaimer: the methods mentioned to identify unreported sales and improve operations are for education purpose only. Do not attempt them on your business.
Here are some examples of what CRA can do, not in order or frequency. 1. CRA will talk to you and ask for financial records like bank reconciliations, general ledgers, and POS system reports. From those, they look for cracks in the story. Financial records are never perfect, especially when multiple staff use the POS system. If things are already chaotic and someone also tries to remove cash sales, that needle starts to poke out of the haystack. CRA can spot mismatches between POS totals, accounting records, and bank deposits. Even missing or out-of-sequence receipt numbers can be used against you. 2. Observation. CRA can sit in the restaurant, count customers, and note the percentage paying cash, then use that to estimate expected cash sales. If this is their only method, restaurants often have a good chance to overturn the assessment on appeal by arguing the sample size or timing doesn't represent the whole year. Last example, net worth analysis for the owner. CRA assumes some hidden cash eventually flows back to the owner, into personal accounts or to buy a house outright. Since CRA already has your reported income data, if your assets look way too big for your declared income, that gives them a reason to dig deeper.
There are plenty of creative ideas out there, but we're not going to list them. As accountants, we'd still like a good relationship with CRA. That brings us to the chain of the underground economy. Cash transactions form a long chain. It's not just the restaurant owner benefiting. Down the line, there might be the butcher shop, vegetable wholesaler, even the container supplier. If they also accept cash and don't record all sales, each link quietly underreports income. Add it up across the chain, and that's a significant amount of missing tax. But a quick reminder, not every cash transaction is tax evasion. Sometimes it's simply a way to move money faster and manage tight cash flow.
Let's head back to your plate. Speaking directly and professionally to restaurant owners, CRA already knows about these tricks. There are dedicated audit teams, court cases, and a toolbox of strategies to investigate cash sales. Running a restaurant is already hard enough. Food cost, rent, staff, delivery apps taking close to 30% on each order, and pushing promos that come out of your pocket. The last thing you need is extra trouble from CRA eating your time and profit. For restaurant goers, next time you see a cash discount, what will you do? Are you just saving card fees and giving up credit card rewards? Or are you quietly taking a tiny cut of a tax fraud? We cannot assume every cash discount is part of a tax scheme, just like you cannot automatically assume every fake panhandler on the street is funding terrorism. We will see you next time.